Hello everyone and welcome to the taxable account review for February 2024. As you can see, we have a new thumbnail for these, trying to make it a little bit more catchy, working with someone on Upwork to produce these, and expect to see that with John and Jane's articles for the retirement accounts. It'll be something similar, probably the same, but maybe some changes in colors. That way, there's a clear differentiation between the videos moving forward. So, anyway, let's take a look at their dividend growth portfolio for the taxable account in February. Not a financial advisor, and I don't claim to be one. Videos made on my own and does not reflect the views or opinions of my employer. Do hold a number of shares in common with John and Jane, and I have those listed on the screen. And it's a real portfolio with actual shares being traded. So part of the reason for all the screenshots is to show validity, that this is a real portfolio, and that the real changes being made in it. Why I do this, John and Jane were taken advantage of by their financial advisor that did some trades that resulted in paying a high number of fees. And pretty much what we came to the agreement on was that I offered to help them, and I just asked that in exchange for me helping them for free, that they allow me to write about it, but also make videos and whatnot, in order to attempt to help other people that might be in a similar position, that don't have a person like me, so that they can help themselves. I just like to challenge conventional thinking, empower people to take control of their money, and it's just something that makes me feel good about what I do. So John and Jane are both retired. John retired in February of 2018. Jane retired in the beginning of 2021. They both collect Social Security. They do collect $1,106.17 a month from John's traditional IRA. And then out of their taxable account, they collect $1,700 a month. It originally started at $1,000 a month. And then John and Jane have other investments outside of what I help them with. And that's going to be mostly low risk bonds, certificates, things like that. They have no monthly debt, or well, not no monthly debt, but basically no debt, no bills other than just regular monthly payments. Cell phone, power, water, things like that. So John and Jane have done a good job of making my life easy, because they can live off of minimal cash flow, which gives us a lot of flexibility. So in the taxable account, generated just under $2,140 of income for February of 2024, and that compares with just over $1,850 of income in February of 2023. So pretty substantial increase year over year. The taxable account had a balance of just under $550,000 as of February 2024, and that compares with just over $533,000 in February of 2023. The portfolio has a annualized cost basis yield of 5.42%. 5 companies paid an increased dividend or a special dividend in the month of February, and no companies decreased their payout in the month of February. So first one is Carrier Global. That was a 2.7% increase. Enterprise Products Partners is a 3% increase. Energy Transfer was a 0.8% increase. Helmerich Payne was a supplemental dividend of 17 cents a share, and that's become something that is regular for them every quarter, and that's in addition to the 25 cents a share per quarter. And then Hormel was a 2.7% increase. So for Carrier, and actually before I get into the specifics there, part of what I set these pages up for is that I want to show on these companies that grew their dividend what the cost basis is of the position. You can see how we layer into these positions. But also I want to show how much in dividends they've paid out over a 4-year period of time, which is the furthest back that I can do a search on in Charles Schwab. And then also, what does that position look like it's going to produce moving forward? Part of the reason why I want to show this is because, one, if this number is low, I want to be able to point out, okay, is the production moving forward, or the income moving forward, high because we recently added a bunch of shares, or is it because the dividend has grown substantially? So basically things like that would help explain how much more it's grown moving forward. So just as an example here with Carrier, is that over 4 years, $250 of income over that time, but moving forward, it's going to produce about $100 a year. Well, that works out to be about $400 over the same time frame. That would be considered a pretty substantial increase. Maybe a little bit of which can be attributed to some shares that were purchased in 2022, but in this case, Carrier prior to this year had made some pretty substantial increases in the dividend that was paid out. So that substantial increase is a big part, in addition to these 40 shares that were purchased here. So again, it makes it a two-part story, where how much of the growth is coming from the dividend growth and how much of it is coming from shares that have been added. In the case of EPD, we did recently add some shares at the end of 2023. And so otherwise that position has not been added to since early 2020. But a substantial amount of income has been produced from it over 4 years, over $3,800 over 4 years. And then the moving forward, it's set to produce about $1,236 annually, which, if you extrapolate that out, is about $4,900 over 4 years. So pretty substantial increase here. So some of it being increases, some of it being recently adding another 100 shares. And then for Energy Transfer, pretty comparable amount to EPD in terms of the amount of income produced over the last 4 years. But because we've added quite a bit more recently, I mean, since mid 2022, that's a total of 500 shares that have been added. That's a pretty substantial amount. But also there was a distribution cut. I believe it was Q3 of 2020 during COVID, when they slashed the distribution in half. So from 2020, for at least the next, I think it was at least the next year, it was paying out half of the distribution that it had been. So if we took this 1,638, multiplied it by 4, that gets us into the range of about $5,500 over the same time frame. Actually, more than that. I take that back. That ends up working out to be like $6,400 over the same time frame. So, so some of it's going to be, now that the distribution has been increased substantially, it's now back to above pre-COVID levels. But also it's the number of shares that have been added here. That's been another major factor as well. Helmerich Payne paid a total of $1,157 of income over the last 4 years. Current position set to produce $250 of income annually, so less than what we'd received over the last 4 years. So basically, the dividend cut that they previously had, that's going to have factored in there. However, that also does not include their new supplemental dividend policy, which, if we include that, that would end up being closer to $420 a year of income annually. And if you multiply that out, that would end up being $1,680 over the same 4 years. So yes, we've added some shares here. We have trimmed back some of our higher cost shares. Yeah, quite a bit going on there with Helmerich Payne between the dividend cut, trimming back shares, adding new shares, and then their supplemental dividend. And then for Hormel, just over $800 of income over the last 4 years. We did recently cut back 25 shares that were at a higher cost basis, and you'll see that here shortly. But with the most recent dividend increase, it's now going to be producing $226 of income annually. So multiplied out, works out to be just over $900 of income over 4 years. So it's been steadily growing, but Hormel does not has not been offering substantial dividend increases over that time. So a little bit of it comes from adding shares, yeah, just a kind of a steady as we go thing with Hormel. So with the February trades, 3 of those are going to be for APD, Air Product Chemicals. After its earnings, stock price cratered, and that was our time to snag a number of shares. We do have a limit trade, set for, I believe it's 275 to trim back some of the higher cost shares. But this was a great time to add shares and lower the overall cost basis. WP Carey added some shares here, just another tranche. Unfortunately, bought it a little bit too early, but you know what? We're not here to time things. Rhythm Capital, this one was actually a limit trade we set for $10 a share to purchase another 100 shares, and ended up working out great because it was shortly after this that the stock price ended up moving up to, I believe it was about $11 a share, if I remember correctly, on some good results. It's sitting at $10.86 a share right now. And then also Energy Transfer, that's one of the tranches that was purchased here of another 100 shares. There was no sells in the month of February, so there's no realized gains to report on. So for the 2024 year-to-date gain loss here, this is good through March 9th. So just understand that this includes March, which is part of the reason why Hormel shows up here and then EPD also shows up here, is because those were actually done on the 5th of March. So here you can see where we had trimmed back Hormel. I mentioned the 25 shares. It was about $39 a share, if I remember right, and that was the reason why we had cut it back and just accepted the loss on it. So year to date, we're sitting in the negative, $313. We do have some shares that are sitting at a gain that we're looking at potentially trimming back or eliminating the position of. So my goal here is just to try and keep this equation relatively balanced. It's not something where it has to be, but from a taxable perspective, it does make it more important that you don't necessarily have a bunch of losses, that you don't necessarily have a bunch of gains, or at least that you just need to be aware of it. So for the people that, like to do lots of trading, taxable accounts are not something that I would recommend at all doing a bunch of regular trading in. Whether you're making a bunch of money or you're losing a bunch of money, it can create havoc on your taxes is all I'm going to say with that. So for our year-over-year comparison here, one of the variables is going to be timing. When you look at Archer Daniels Midland here, you can see where we received the dividend in 2024 in February, but now I believe it was received in March in 2023. So that accounts for some of the increase in the income. And so we'll find out in March, just how much of that is. But also with EPD and with ET, you can now see that these produce quite a bit more income than they did previously. And then also with APD, you can see that this position has more than doubled in terms of the amount of dividend income, and that doesn't even include the dividends from the shares that were just purchased. There's some income coming from CDs, but also we have shifted funds into Charles Schwab money market. So there's going to be more coming in for the month of March and April. You'll end up seeing more income from CDs and Charles Schwab money market for the taxable account. So for the full year comparison, I know it can seem kind of odd that I have a dividend growth portfolio and I'm talking about negative growth. But I think it's really important to consider that when I come up with these estimates, I am wanting to present things in a way that is not overly optimistic. And I'd rather go for the approach of under promise and over deliver. So when I use negative, 8% was our estimated starting point, that was just kind of saying no dividend growth, just no interest earned on CDs, no interest earned on money markets, just trying to come up with okay, if things got really bad, what could we expect? Maybe some dividend cuts happen or something like that. So with that 8% as the starting point, by the end of January it moved to negative 7%, so increased by a full 100 basis points, and then now it's increased again by another 140 basis points, and that gets us to now negative 5.6%, basically through the month of February because of the income growth here. So even though they've made a lot of progress, it's still going to be several months, in my opinion, before we see it get into the positive. And there's a table at the very end here that'll really, I think, help people visualize that in case you have questions. But also, we do have more money being shifted into CDs and in the Charles Schwab money market. So we can expect to see more income to be coming from that because we're going to have less cash sitting on hand and more invested in these other liquid sources. So John and Jane have also been the ones to elect to continue receiving the $1,700 a month, even though the portfolio is likely going to produce more than that. They're going with, they're being conservative along with me. But I think that as we see this, grow and get to a more realistic end of the year number, we're probably going to be looking at an average monthly income, in my opinion, closer to, mid 1900, maybe even $2,000 a month if things really work out. So for the balances, I mentioned previously that February balances compared to 2023, it's up about 15,000. Looks like I might have been a little bit redundant here, but it's actually compared to January of 2023, it's almost at the same level. The part here I really want to draw attention to is that this balance here is actually what it is after the $20,400 of income had been drawn out that went into John and Jane's bank account. So even though they've been drawing out that income, their account balance is $15,000 higher than what it was the previous year. And so this really helps underscore the importance of a dividend growth portfolio and basically being patient, not overreacting to things, and the consistency that comes from, a dividend growth model like John and Jane's. So, the idea that we could take that $20,400, add that back on top of this, and then that also doesn't even include, so with this year, for 2023, there was also $20,400 that was drawn out, and you'll see, again, I have another table for that, but you get the point here that the balances are remaining high, they're getting their income, and that's the whole point of doing this, right, is that we have a sustainable portfolio that's producing an income that can be recurring every single year, regardless of what the balance is. At the end of the day, that is the goal, and that is why we do what we do with this. So for the 7-year income comparison here, even taking into account this negative 5.6% that we're estimating for the remainder of 2024, worst case scenario, that would end up resulting in a cost of average goods returned of just under 13%. 13% income growth over the last 7 years. I will say that 2019 is going to be an outlier. Part of the reason for that is that 2018 was the year that we did the transition of the portfolio. So it's making it look like the growth was greater. And then in 2021, you're going to get kind of like the post-COVID boost, essentially from a lot of money that we had invested during COVID that worked out in John and Jane's favor. But here, where you're seeing these mid to upper single digit increases, that's going to be what we're looking for consistently year after year. And that's why you see me project 3%, 5%, and 7% growth, because that is what you can reasonably expect from a good dividend growth portfolio year after year. And then the cash balance comparison here, cash balances started off at a high point, in the taxable account. And it's also important to remember that these numbers up here do not reflect what is in the Charles Schwab money market or in CDs. So for example, if we look at this 24,000 here, we would also need to add back in the $25,000 that's in SWVXX, and that would actually be the true amount of cash on hand. But for consistency's sake, this table here is really only looking at what is the actual true cash on hand. And I like to, again, use averages down here. So we've grown the average since 2023, but we're only 2 months into the year. But I expect that this number is going to actually go down next month, because we're adding more into Charles Schwab money market, but also into certificates of deposit. And then for the unrealized gains here, so we're sitting at a high point for 2024. Unrealized gain loss is higher than in January, but still lower than where we ended in December of 2023. You can see here for the averages of where things ended at, and it's, again, continued to steadily grow. We're only 2 months into the year, so there's the possibility of fluctuation, that's for sure. But I still think it's good to see this general trend here. The taxable account has done well in terms of consistency with that. So the withdrawals comparison, as I mentioned, remaining the same at $1,700 a month. And then prior here in 2022, when withdrawals were first starting to be made, that's when they were taking $1,000 a month. So no funds have been added to the taxable account in years. So that's another important thing to know, is that it's not like these results have been boosted, from adding a bunch of money in and using those, that money to, add CDs and things like that. This portfolio has not had money added to it in, I think since like right around COVID or right before COVID. So we're talking, going on almost 4 years. And then if we were to factor in, as I mentioned in that previous slide, the $20,400 into the balance, we're sitting at a balance that's $15,000 higher than it was in the previous year. And that's without even accounting for the $20,400. So that balance would be significantly higher. And I always like to point out that if we took that $20,400 and reinvested it, in a 5% CD or did something like that, it would generate a substantial amount of additional income. So it goes back to the power of compounding. This table is the one that I had mentioned will help clarify, I think, the direction of the portfolio moving forward. And I apologize, I found an error on the previous one. So if you go back and watch the January video, you'll see where this increase year over year number was, I think it was like 15% or something like that. I had actually put a manual number in the equation on one of these that was inflating it. And so this is going to give a more realistic expectation of the direction that things are going. So the way that this works is this column represents 2023. This column here is going to say the amount of income when we exclude CDs, money markets, things like that. This column is going to say what we estimate income-wise will come from CDs and money market. And then the total amount is just these two columns added together. Part of the reason why I wanted these separated out is that when I look at it and say, okay, I'm going to estimate what the income would be, if it's a 3% increase, 5% or 7%, I didn't want to include the CD income into that or the money market income into that because with those, we're not estimating dividend increases, right? There's nothing, those numbers are consistently the same. But there's never like a CD that just says, hey, we're going to raise the rate that we're going to pay you. And if you guys have found a CD that's like that, let me know because that would be great. But we isolated those so that way we could better understand what kind of increase could we expect. And so these columns here are really meant to be what would the income combined need to be to achieve a 3% increase? What would the income combined need to be to achieve a 5% increase and then a 7% increase? So you can see for the month of January here, it was a 22.2% increase year over year. That's this income here over this income here. 15.52% here, that's this income here over this income here. So as you can see here, we would have, to achieve our 7% increase, we would have needed $1,980.33. I wanted to keep these numbers at the 3, 5, and 7 because, again, that's the numbers that we're consistently shooting for. But as you can see, the growth for each of the first 2 months of the year over year, has been in strong double-digit numbers. But when we get down here to the bottom, if we were to say, okay, assuming that the rest of this year ends up exactly as we have projected, we would be looking at a 2.8% increase year over year. And that's where these numbers become a little bit more realistic, that this number is just slightly below here, and that's why it would be at 2.8%. But here's what we would need to see numbers wise in order to achieve 5 or 7% growth across the portfolio year over year. So hopefully that ends up explaining things. And actually it looks like down here I had noted this, that I had put something like, it was like 20% in here. Like we were projecting some crazy dividend growth. And in this case, now that that's been corrected, we won't have that problem in the future. So thank you. I apologize that happened. And then here for the current gain loss table. So this has been updated as of March 13th. All the new numbers have been pulled in. You can see down here where we have the money market and CD that I mentioned. So now it's $40,000 in here, and we only have the $10,000 in cash on hand. So those trades have already been executed. It's already been updated. And then the unrealized gains are up since the end of February. That's going to be reflected down here in this $130,611. So the fact that it's up another $9,000 within about 2 weeks time is again nothing I'm going to complain about. But also when you're looking at the gain loss table here, we added these additional columns to give some perspective. I've always had this percentage of account column here to kind of reflect how big is this position relative to everything else in the portfolio. But I also, I think it was a suggestion from someone on either Seeking Alpha or maybe on one of these videos to talk about the percentage of income that it produces. So a great example is going to be Apple stock here. It makes up just over 5% of the portfolio, which is pretty sizable compared to most of the positions. But it makes up a minimal amount of the total income, not even 1% of the total income that is produced in the taxable account comes from Apple. Now, we all know that Apple has a relatively low yield with it, but when we look at maybe some of these other positions, EPD makes up 2.6% of the account, but produces 5.75%. This is a helpful tool to use so that we know, okay, how much exposure do we have to any one position in terms of its account balance, but also how much of John and Jane's income is exposed to that. Because let's say we had a situation where, like with ET, it slashed its distribution in half in 2020. If that got cut in half, and this was reduced down, that would have a substantial impact on John and Jane's income that's being produced. So what we're looking for is we just want to make sure that everything, remains within reason. And when we look at something like, EAFAX, it's only 4%, but it produces 9% of the income. Because it's a diversified fund, not a huge concern, right? But if this was an individual specific stock, this might end up being a higher yield stock. But really, we just need to ask ourselves the question, are we willing to have that much exposure to something? That's the question at the end of the day. So, this is the one that shows the good and the bad and the ugly. And as I've always said, really be aware of people that try and make it sound like their portfolio is doing great without showing all these things, because it's really easy to cover this stuff up. As you can see from the amount of screenshots and slides we've had to go through, that all it would take is for me to cut out a couple of slides. And I can make it look like the portfolio is doing really good while hiding, for example, VF Corporation and Washington Trust Bank Corp and WP Carey. We're talking about, $15,000 in losses potentially right here from just these shares. And that's something where, I could easily sell out of these positions to make it look like my portfolio, that everything is sitting in the positive. So really just be aware of how much data someone's presenting. And yes, it might seem overwhelming, but the idea is that there's always bad that comes with the good. And in this case, that's why I present so much. Because once you kind of get used to the fact that the two go hand in hand, this portfolio is performing extremely well, in my opinion, even with these negatives that you see here. So anyway, thanks, and I apologize, and thank you for the people who've had the nice comments about mentioning about the loss of my grandfather. I appreciate that. He was actually the person that originally got me into investing. I didn't necessarily agree with him on his methods of investing, but I do give him credit for being the one to first kind of teach me about the stock market, and he was a good man, and I loved him, and so anyway, between that and then just the lack of sleep, it's made doing these, keeping up with these videos a little bit more challenging, and writing the articles a little bit more difficult. So anyway, thanks everyone. Appreciate it. Let me know if you have any comments, thoughts, questions. Would love to continue getting more traffic going on there, because again, the YouTube algorithm is not very favorable to me in the way that I do things. So hopefully a thumbnail really spices that up and improves that. So anyway, have a great day, everyone. Thanks.